Good afternoon. Now it's afternoon. Good afternoon, everybody. Welcome to the Long Beach Community Foundation's Strategies and Charitable Solutions webinar, specifically focused on required minimum distributions. My name is Marcelle Epley, and today I have Tony Gales joining me today, CPA for BPA. And before we get started, I just want to let you know that the 60-minute presentation is being recorded, so it will be emailed to you if you've registered, so you can watch it again or want to look at the slide deck. And please do use the Q&A feature in the Zoom, so that way we can address your question. If for any reason we can't get to you today, we'll certainly get back to you if you reach out to us directly. And feel free to ask questions as we go along, and we'll answer them, or you can save it till the very end. And this does qualify for 1 hour of the continuing education credits. And you see an email there, stacy@longbeachcf.org. Please email her for the certification, and we'll get you set up. All right, so let's go ahead and get started. This is what we're going to be covering today. Specifically, what are required minimum distributions? What are qualified charitable distributions? What are the limitations? And then what are options for either you or your client in order to turn those into charitable funds or creative strategies that can get you and meet your goals? And then lastly, we will cover what about legacy giving? How do you make the IRA work for you in your will or trust? And so we will we'll cover that as well. Okay. So first we want to know who's in the room. And this was, so please go in and take the poll and let us know your background. This was sent to mainly financial advisors and attorneys and CPAs, sort of the professional advisors that the Community Foundation regularly works with, but it is open to everybody. Perhaps you have reached the age for a qualified minimum distribution, and you want to know what options that you have. So it looks like we have financial advisors in the room, trust attorneys, and other. And so other you might be a fund holder of the foundation, you might be a board member, you might be a partner with us, and we just want to welcome you and really appreciate you taking the time out of your day to listen to this really important information, one that's really talked about, quite frankly, in our circles. So next, I want to introduce Tony Gales. Tony has decades of experience and really is a top-notch professional in the industry of accounting. Not only is he really the pro and really known regionally, he also himself serves on board of directors, including the Long Beach Community Foundation, as well as those that you have listed here. He and his firm have won numerous awards for their work in the field. And so we're going to start off with Tony Gales talking about qualified minimum distributions. Take it away, Tony.
Thank you, Marcelle. That was a great introduction. I could not have done it better myself. Let's go into just a brief definition of the required minimum distribution and why they exist and how they're calculated. So required minimum distributions are the minimum amounts that a retirement plan account owner must withdraw annually. Now, that annual withdrawal begins, currently it begins at the age of 72. Prior to January 2020, the age was 70 and a half. Now, the amount that is withdrawn is based on an actuarial table issued by the IRS. So you may wonder why it changed from 70 and a half to 72. Well, in the late part of 2019, the IRS took a look at the law and said, okay, people are living longer, our life expectancy is increasing, so we are going to change the RMD age to 72. And then a few months later, COVID occurred, and then our actual life expectancy decreased by 1.8 years. So in case you didn't know that, I hate to rain on everyone's parade there. So the table that the IRS was using to calculate RMDs had been designated in the year of 2012, and it was not changed until 2020. So not only did the IRS extend the time to begin your RMD, but they also stretched the actuarial table. So your annual RMDs are lower than they used to be. So if you had RMDs up until 2020, your amount would have been a little bit higher than it will be calculated as of now, based on your expected lifespan. With respect to your RMD, this amount is something that must be withdrawn on an annual basis once you reach that age floor. If you do not take your RMD, you could be subject to a 50% penalty on the amount that you failed to withdraw. So let's say, as an example, I had an RMD of $20,000 in 1 year, and I failed to withdraw that RMD by December 31st of that year. It's very possible that I will have a $10,000 penalty on that failure to take my RMD. So it's important that you are in touch with your financial advisors, your CPAs, or whoever else is on your financial team to make sure that you're taking your RMDs on an annual basis, because the penalty is pretty hefty. Now, on the flip side of that, let's say you take your RMD like you're supposed to. The unfortunate part is that it's included in your ordinary income for that year. So you take your age or your retirement age and you calculate based on the IRS table, you come up with your amount, you take out 40,000 as an example. And now that 40,000 is included in your ordinary income. And your financial advisor should be withholding tax on that. And hopefully you can put your financial advisor in touch with your CPA to calculate the expected tax on that so that they withhold properly. But in any case, your RMD is included in ordinary income. However, if any part of that RMD is a return of basis in your IRA, it is excludable. And if it's a Roth IRA distribution, we all know that the Roth IRA distributions are tax-free. So IRA distributions from a traditional IRA or Roth IRAs can also be excluded from gross income if we include them in a qualified charitable distribution. And that's one of the things that we'll be discussing today. What are qualified charitable distributions? Now, I will admit that for quite some time, I didn't know that this option was out there. Marcelle is the one who introduced me to the idea, and I feel like it's a little used option for IRA recipients or individuals who have RMDs. But with respect to a qualified charitable distribution, you have the option to exclude it from income. And you can exclude it from income if the IRA RMD is made directly by the IRA trustee to a charitable organization. And that charitable organization cannot be a private foundation or a donor advised fund. So let's say, as with the example of 40,000, I reach out to my investment advisor and say, okay, I've got an RMD this year of 40,000, but I'm not looking forward to paying ordinary income tax on it. I want to make sure that I can exclude it. And on the other side, I was planning to give approximately 40,000 to various charitable organizations or one specific organization this year. So I would instruct my financial advisor to make my RMD distribution directly to one or more qualified charitable organizations. So that would be one way that I could exclude it from my income and avoid, I hate to use avoid when I say income tax, but I would reduce my income tax liability for that year if I were to choose that route.
Tony, we have a question as it pertains to this, so I do want to mention it to you from one of our attendees. They're asking, what is an example of an RMD being a tax-free return of basis? Can you help answer that question?
Yeah, there are situations where if you had a non-deductible IRA, I believe, and you've got basis in your IRA that is not taxable because you didn't take the deduction, or it was previously included in income, that portion or that basis would not be included in your ordinary income. I hope that was helpful to Mr. Takahashi. Okay, so with respect to the direct contribution, the IRA trustee must make the qualified charitable distribution directly to the charity as stated. And the RMD recipient or the IRA holder cannot take possession of that RMD before the charity receives it. So the check must be sent, or wire must be sent directly to the charity, or the check must be paid directly to the charity, and the IRA holder can deliver the check. But the money cannot be deposited into the RMD hold or the IRA holders, any of their accounts, or they can't be the custodian of those funds prior to it going to the charity. Otherwise, you would still need to include that amount in your ordinary income. Let's go over some limitations to the qualified charitable distribution, because obviously, you know, everything can't be too good to be true. So one limitation, well, I think this might actually be a benefit, and I sort of touched on it with respect to income tax withholdings. But if you do a qualified charitable distribution, it is not subject to income tax withholding under Internal Revenue Code 3405. When you do an RMD or a normal RMD, as stated, you would typically have your federal and state withholdings. If you're in a state where there is income tax, you would have withholding on that, and you would receive the net amount of your RMD. With a qualified charitable distribution, income tax is not withheld, and the full amount is distributed to the charity. So in the example of 40,000, let's say I had a 20% individual rate for federal purposes and a 10% California rate. That'd be roughly 30% in tax that would be withheld on a normal RMD. That 30% would not be withheld if I were to do a qualified charitable distribution for that year. Now, qualified charitable distributions are only excludable from gross income if made on or after the date the IRA owner attains age 70 and a half. And you may say, well, when else would I have an IRA distribution, or why does that even matter? Well, there are situations where individuals inherit IRA accounts from relatives or from another individual, and the recipient may be under the age of 70 and a half. In that particular instance, the RMD that recipient is required to take cannot be excluded by using the qualified charitable distribution rules. They have to pick that income up in their ordinary income. So you have to have reached the age of 70 and a half to use the qualified charitable distribution function. Another limitation for the qualified charitable distributions is the amount of the annual exclusion. So with $40,000, you know, let's say I didn't save enough throughout the years and my RMD's pretty low, you know, my $40,000 RMD will be below the annual exclusion of $100,000. But let's say I had started saving early in my lifetime and in my career, and I built up a pretty large nest egg to where my RMD was greater than $100,000. I would be limited to a $100,000 exclusion on an annual basis. And that is specific to an individual taxpayer. So if I were filing with my wife and she did the same thing, and let's say we both had RMDs of $125,000, we would each be limited to $100,000 as a qualified charitable distribution. And to be a little bit more specific, if I had an RMD of 125,000, but my wife had an RMD of, let's say, 75,000, with, we both had total RMDs of 200,000, my wife's RMD qualified charitable distribution would still be limited to 75,000 because the exclusion is $100,000 per individual IRA owner. As a married filing joint couple, you don't get to double up the exclusion and take 200 for both individuals. It's a specific $100,000 amount per IRA owner. Now, one limitation that I think we all deal with on an annual basis when we give to organizations and we give to certain events that are put on by organizations is that, generally speaking, the benefit that you receive from a charitable contribution to any organization is limited by the amount of benefit that you receive from the organization. So if you are at a golf tournament or a charitable dinner, the amount of fair value that you receive as a benefit for that outing or that event isn't deductible as a charitable contribution, although most people do it. My clients will say, I gave $5,000 to an organization, and we sort of take it at face value, and either they will know or sometimes the organization will say, okay, from that $5,000, you receive benefit of, $150 in meals and other entertainment. Now, the amount that you receive as benefit cannot be excluded as a qualified charitable distribution. Furthermore, if any part of the amount that you send to an organization as a charitable distribution is a portion that you receive benefit for, it disqualifies the entire distribution from being a qualified charitable distribution. So my recommendation would be to first, if that is a potential with your donation, you need to reach out to the organization and you need to say, okay, well, how much of this will be a benefit to me? And you'll need to split your donation to the organization for the amount that's entirely charitable, and then the amount that you'll receive a benefit for, because the amount that you receive the benefit for, you would either pay out of pocket or you would have to pick up in income for your RMD so that you don't disqualify the other portion. So your distribution needs to be completely charitable in order to be a qualified charitable distribution in a given year.
I'm so glad that you brought this up, Tony, because here in Long Beach, especially, nowadays, there are so many events to go to and so many charities to support and support their great causes. And a lot of people that work with the community foundation want to attend those events and want to be able to, move money out of their fund and pay for tickets and tables. And there's definitely restrictions around that, required minimum distributions and donor advised funds. So if you are wanting to use, some of your required minimum distribution to purchase a table, and the best way to do that is to contact the charity directly and ask them for what is that amount that I'm receiving a benefit, like the meals and entertainment, and what is the portion going to charity? It's kind of an interesting question to ask anyway, right? Just to see how they're financing everything. But regardless of that, for you personally, and to avoid, getting into trouble here, it would be best to contact the charity, find out what is the direct dollar amount. So if you buy a table for $5,000 and the charitable portion is $2,000, direct your IRA provider to send $2,000, and you're going to have to pay for the other part separately from another maybe account with your financial advisor or such. But that would be our advice on that. And since we're talking about tickets and tables, and it's kind of related to this, and I know we're going to talk about donor advised funds later, Tony, but you cannot at all buy tickets or tables with a donor advised fund. at all, because you can't bifurcate or split those off. Those have to be totally, completely separate transactions as well. So just
Oh,
another,
wow.
yeah.
I'm
So
going to have to revisit some of the thoughts behind my own personal donor advised fund and what I do.
right, yeah, you just want to be careful. But the nice thing about working with the community foundation, and Tony, I know you have your donor advised fund here, is that we catch those. And not only with our team here in Long Beach, but with our team in Greater Kansas City, which is a much larger team of about 100 people. We see, and we know locally what the events are, but we do watch those donations carefully, and we help you out and catch you there if there's something, if you're about to do something that wouldn't be permissible by law. So this is a very important slide.
Okay, is that something that you review with all of the donor advised fund distributions?
Absolutely.
Okay.
Absolutely. It's in the tiny print. But if you're not a tiny print reader, then we certainly mention it, or we look at the donations as they're coming through to catch those. And if you send it to your RMD check to the community foundation and are directing it to another organization, like we'll talk about later, and it's for an event, we'll make sure to contact you and or your IRA provider to make sure we're doing it above board and doing it accurately.
Great. That's good to hear. Good to hear. Okay, so we have our second poll question here. So if you were listening, hopefully you will have the answer to this. I believe it's pretty straightforward. But the question is, what is the married filing joint limit for an IRA qualified charitable distributions?
I'm really glad we run these polls because it tests people's knowledge, but also I do know it's a requirement for the CLE credits, for continuing education credits. So jump in.
And this may appear to be a trick question, and it is. I think there are two answers here. So most people appear to be correct in whichever way they're thinking of it.
Looks like those answers are coming in as far as they're going to come in today, Tony.
All right, so there are two answers here. The individual limit is 100,000, and for two people, it's 200,000. So I can understand, and maybe it's the wording of the question where people chose 100,000 because that is the individual limit for one IRA owner, and 200,000 for two owners. So no matter what, the limit is at 200,000 for a married filing joint couple and 100 per person in that couple.
But like in your example, and I forget which spouse had 125,000 or 75,000, but for the spouse that has 125,000 and the spouse that has 75,000, you couldn't say, okay, we have 200,000 together and we're going to contribute.
No, it's still correct. Yeah. So in that example, I had saved more, so my RMD was 125. I would still be limited to 100,000, even though my wife would be under the limit at 75,000. So at that point, I could make a charitable or a QCD of 100,000, and she would make a QCD of 75,000.
Great. Thank you, Tony. We are going to jump to kind of talk about some solutions that once you've reached that age and you have this distribution that either you can bring into income or make it work for you if you're charitably inclined. A community foundation is a great place to work with because we can do things with those charitable distributions that traditional banking institutions can't, because we ourselves are a charity. We're a 501c3. We're one of over 850 in the nation. We were grown out of the Estate Planning and Trust Council of Long Beach. So it was trust attorneys and CPAs and financial advisors that got together along with some real matriarchs and patriarchs of this city that are very charitable themselves, that said, we need an entity that can help us, with these complicated transactions, that can help us house our funds, can be fiduciaries, can be overseers of what we're doing, and not only what we're giving today, but in our will and trust. And so that's why community foundations exist. They typically have local expertise. For us, we have local expertise and a national reach with our team in Greater Kansas City. The grants that leave the foundation can go anywhere in the United States. So they're not limited to Long Beach, but working with us means that you're supporting Long Beach because the little fee that we charge supports our community and the causes and the needs here. And we know the community, we know the nonprofits, we know the causes, we know the executive directors, we know their financials, we know their boards. So we're experts in that sense. And you see a logo on the bottom right-hand side that stands for national accreditation. We are national standards accredited and have been forever. And that means that we adhere to the highest policies and procedures in the nation. And it's a very strong self-audit that we undergo that's rigorous, but it's worth it because we're always up to speed and up to date on what the best policies are and kind of looking ahead too to see what's coming down the pike for our clients.
Marcelle, I have a quick question for you.
Uh-huh.
Do you know where the Long Beach Community Foundation ranks in terms of size and reach for Southern California community foundations?
You know, in California, we would be considered a mid-sized community foundation. We've grown pretty significantly over the last 8 to 10 years. So I think we are mid-sized, and maybe soon enough, we're going to kind of cross that midline for community foundations. Because primarily who we work with are folks that are managing individuals, IRAs, their checking accounts, their savings, their stocks, their portfolios. And so having us sort of known in the community and working directly with financial advisors, for example, really just broadens the reach of what we do and what we can provide. Okay. And as you can see here, great question. As you can see here, these are the folks we primarily work with. We work with individuals as well. If you're an individual on this call and you don't have a financial advisor and you want to contact us to help with your specific gift, we welcome that. So I just wanted to mention that. So here's, you have your RMD, and what can you do with it? And Tony went over, you can give it to charity, but what else? So we are a charity, I mentioned, and these are specific funds that I'm going to be covering for you today that either make the original donor or the IRA owner very involved, a little bit involved, or not involved at all. And I know that we all have clients that are in that spectrum and in that range. So we'll start with what is an endowment, because I'm going to be mentioning that throughout my presentation. And for those that don't know what an endowment is it's a fund where the principal balance, or that corpus as it's called, is never spent. Rather, what's spent is the income that is earned from that. So we have like a fruit tree here, and you pick off, the lemons, but more grow over time. And in many instances, and it's an in perpetuity or forever fund, the amount that you're giving away to charity out of this pot will far exceed the amount of your original contribution. So if you put in, for example, $100,000 in as little as 10 years, you could be giving out up to $100,000 and then beyond that. And we talk about a lot about this because if you were to have $100,000 to give away to charity, if you give it away to them or a group, it's gone and it's spent. But if you have an endowment, it exists forever. And that is a permanent income stream to a very lucky charity or charities. And that's one of our specialities here at the Community Foundation. And so our spending policy, and it's in alignment with many others throughout the nation, is we spend 4%, because in years past and with family foundations, it's 4% or 5%, and 5% is required out of family foundations. You must spend 5%. But as we've seen over the years and decades, 5% is not sustainable. You continue to spend that, you could very well eat into that principal balance or corpus. And the goal of an endowment is to freeze that and not invade it. We look back 3 years because as we all have seen last year and this year, the stock market goes up and down and up and down. And if you were to draw a line over those up and down movements and corrections of the stock market, you would see that 4% is kind of the line that we like to walk on. So we feel here at the Community Foundation, many other foundations and community foundations, 4% is the right amount to maintain that corpus. It works very well for estate gifts. So when we're not here, we leave a never-ending pot of funds that will forever support a charity in you or your client's name. And as I'll talk about later with endowments, they do exist forever. But what happens to the charity? So we'll cover some of that as well if for some reason they close their doors. So
Marcelle,
yeah,
I have a question. Is there a minimum to create an endowment, a minimum amount?
that's a very good question. The short answer is no, but if you're, I think if you were to go lower than 25,000, for example, that 4% distribution that comes out of there, it's small, but it could be very significant. You know, it could be a $2,000 check going to a small charity every year, which is terrific. But the risk is that even with tiny fees, it's hard to maintain $25,000. And our fear is that if you start to go below that, like 10,000 or 5,000, then our little fee and stock market fluctuations start to erode that corpus, and it shrinks over time. So we would recommend over 25,000. However, we do have clients that set up for much lower and a much lower balance, and they just add to it over the years. So an example for what we're talking about today, if you wanted to start an endowment through some of these funds I'm going to go over, and maybe you only have $10,000 from your required minimum distribution, you could do that today, and then next year add another 5,000, the other year add another 10,000 or 7,000 or whatever the dollar amount is to build that up and to grow it. Great question.
Thank you.
You're welcome. And so I want to encourage everybody to use the Q&A as we're going along here, because it's really great to be able to answer the question kind of in the moment. But if you want to jump in later too, that's totally fine. So the first fund I want to cover is a designated fund, and it is exactly like it sounds. Your client or you yourself are taking your required minimum distribution or something from your checking account. You could do either, but for the purposes of today, you are establishing a fund where you are designating in advance which particular charities you want to give a gift to. So I'll give a illustration of that. And this works great for required minimum distributions because you cannot put it in directly into a donor advised fund. This is as close as you're going to get without having to pay a tax penalty, because you can choose the charities in advance and then you sort of set it and forget it. It creates that permanent income stream because it is endowed typically. However, we could work with you if you want to put some money out today and then leave the rest for your chosen charities. So we are flexible to that extent. With this and all of the funds, for the financial advisors in the room, you don't have to go in our investment pools. It makes no difference to us. We're happy to have the investments housed with you and you continue to manage them. And then we're sort of the administrator of the fund outside of that. So we can work with you however you would, whatever works best for your client's goals. And what kind of clients are right for a designated fund? Well, they probably have been involved with charity for some time, so they know the names of the charities, they like what they're doing, and they really want to earmark them specifically for a gift that could last forever and long after they're gone as well. So here's an example. Mr. and Mrs. Lee, they establish a fund either in their name. They could call it the Lee Family Foundation, or they could call it the Charitable Family Foundation. It doesn't have to have your name on it, but many like to put their name on it. And they go to their IRA provider and they say, send a check, 100% of my distribution this year to the Long Beach Community Foundation. I mentioned earlier here that we are a charity. We are a 501c3, so we are a qualified charity to receive that check. But what happens when it comes here? It doesn't come to us necessarily for our purposes, but it does come to us to be distributed according to your client's goals. The Lees in this particular example chose several charities you can see there. They do need to provide us with a percentage amount. And that's something they want to think about. It looks like Precious Lamb is their favorite, followed by Algalita Marine Research. They've got some Long Beach-based organizations here. And when that distribution comes to head here at $4,000, it's an estimate. It sits in an account when it arrives here, and it has to earn income for a year. So it sits in an account, earns income for a year. We make the first distribution 4%. Presumably, it's going to earn some investment income, but for simplicity's sake, we'll just say we're sending a $4,000 check and we distribute it according to the charities like you see on the screen. And that's exactly what we do every year. The client doesn't need to be involved, but they can have access to the account to see that it's going out. So that's a great benefit there. So it's kind of set it and forget it, but they do have the ability to choose the charities. A field of interest fund, on the other hand, is like it sounds, they're choosing something that personally interests them. So this could be anything from education to the environment. It could be the arts. There's a lot of different causes out there, as we all know, and some are very specific and some are very broad. But it's up to the client, with our help, if they so choose, and the help of their advisor, to help them narrow down a specific cause. And you could have a broad focus like listed here, youth educational programs in Southern California. We would probably shy away from that, because you would have, as we then take it to sort of the streets as it is, to invite charities to apply for this particular grant on your behalf, we'd have thousands of charities, because most charities provide educational youth programs. And Southern California is a very wide net. So if the person was charitably inclined specifically for Long Beach, maybe we want to narrow it to Long Beach or the greater Long Beach area. And maybe we want to talk about K through 12 youth specifically. Maybe they're at or below the poverty line. So let's narrow that down to really get specific on what they want. And you can get even more specific. You don't want to get too specific, though, because according to the IRS, a charitable contribution has to go to the broad masses. So we couldn't say the charities that are along Atlantic Avenue in downtown Long Beach, for example. This is a great option, just like the designated fund, to take what you established today and put it in a will or trust, because it's almost like an open account that would be ready to receive your trust assets upon death. And so that's a great way to get involved now, to see the fund. You can go online and look at the account, see who's getting the grants, see who's qualified here. In this instance, it's the Community Foundation Board that chooses the charities. So this one is really hands-off. In this instance, your client or you yourself would not have any choice, and maybe you don't want to be the person picking and choosing the charities. So this one would be right for somebody who maybe is charitable, maybe they give here and there, but they really don't have any favorite charities, but they're very passionate about, they read the news, they watch the news stations, and they're very passionate about a particular subject. So we would want them to narrow down and then know that that money is going specifically to support their cause that they cherish. Maybe it's something during their lifetime that they went through. So
I'm sorry.
Yeah.
Another question. I'm learning a lot here. So with respect to the narrow focus, what if the focus becomes too narrow and I want to change my mind in another year? Is that an option for me in the field of interest fund?
It's a very good question. And the answer is maybe. So ideally, these funds, they earn income. You've established, a specific focus. If, for example, if it's maybe not working, maybe we chose Long Beach and that's not broad enough, for example, we could go in and tweak it a little bit, as long as outside money hasn't come in. The reason why is because when people give to a charity or even a charitable fund that has a mission statement or a specific focus, their expectation is that I'm giving to that focus or that field of interest, and that's what my money is going to be used for. We couldn't go in and change it so radically that now it's supporting something completely different. So in the event of a client who is just one donor, there really wouldn't be any issue in doing that.
Okay.
But you have to understand too that in the legal language, when that donor makes that donation, it's no longer theirs. It's under ownership of the community foundation. And we would work with them to fine tune or tweak. But ideally, we would spend time up front doing that. So we wouldn't run into problems later. But the short answer is we typically could do that again, as long as no outside donations came in, which is an option. This could be something that you open up to your family at Christmas time, for example, open up to your neighborhood, post it on social media. You could say, I care about this particular cause, and outside people could contribute to it and it could grow. So that's the exciting part of it. But you can't change it then after that. You have to stay true to what you promised.
Okay, so given the opportunity to do a qualified charitable distribution annually, it might be better to set up a separate field of interest fund. I mean, there's no limit to the number of funds. Is that correct?
Correct. We have several clients that set up specific funds for all sorts of different uses. And so let's say you set up a field of interest fund to support, the environment, air and water. And now you say, well, I really want to support after school programs for our youth. That's totally different. You would set up a separate fund for that. Okay. We do have a question in the chat. With this option, with the field of interest, would the charities be the same every year, or do you select different ones each year? So actually this participant is talking about the designated fund. We would distribute to the same charities every year, and that is set in stone. That wouldn't change. The reason why is because if it did change, and if we went in there every year and tweaked it and changed the charities, then it becomes a donor advised fund. Now the donor is involved in picking and choosing, but if you just solidify it up front and lock it in, then now it's in the realm of the community foundation to manage, because the IRS does not want you donating to a donor advised fund. The kind of history behind that is because a lot of the charities came forward and righteously so to say, you've received the tax benefit. How come we can't have it? It's sitting in this donor advised fund. So there's a lot of advocacy at that level for that. So it is being looked at quite extensively. So same thing with Mr. and Mrs. Jones. They send their RMD to the community foundation. And what happens is it comes to us, and the Jones family, in this case, at the very bottom, you can see here projects and programs that educate children on the effects of climate change and how to recycle and reduce waste. So that's a great example of a field of interest that is specific enough where we can get enough charities applying for it, and we can really carry out their wishes. Same process there with the endowment. Scholarship fund is another option for folks that maybe received a scholarship in their lifetime and want to pay it forward. It's a great way to kind of fine tune. Maybe you went to school for engineering, or you're a teacher and you want to support the next generation of engineers or educators. And so you can work with a committee. You can be totally out of it, have the community foundation handle it, or a mix of that. You could be on the committee that reads the applications. Just depends on the level of interest that the donor would like to have. But the process is the same. A committee is formed. The community foundation solicits students to apply, high school students, and then distributions are made directly to the educational institution, so the student doesn't have to pay taxes on it. And so, Tony, we have a question here, and I know we're getting into kind of that last 15 minutes, so I think we'll just answer questions along the way and see if there's options for after that. There was an answer. Let's see if I can see. Oh, Tony, I see you've already answered it. So since I brought it up, the question was, in the case of Mr. Lee, for the tax deduction for the year, is his tax deduction $100,000 or $4,000? So remember, he gave $100,000 to a charity, to us, at Long Beach Community Foundation. Once it comes to us, he's got a tax receipt for $100,000. The $4,000 that's being distributed every year from the endowment, that's just money that's going out. But Mr. Lee and Mrs. Lee's role now is out of it. They're done. And Tony, did you want to add to that? Because I see you typed in the chat there.
No, I just want to say that just to add on to what you said, that $100,000 is the gift, and the $4,000 that is given on an annual basis is a gift from the community foundation to the organization. So if there was a desire to give more and to take advantage of that tax benefit, there would have to be another gift to the fund or the establishment of another fund, but the income that is distributed to the charitable organization, that's technically from the community foundation because they became the owners after the initial $100,000 gift.
Exactly. And this might be a good opportunity to bring up a little bit more on that, because if the donor is donating $100,000 to the community foundation, it's presumably going to grow over time, right? We hope that the fund is not just earning 4% every year, but it's earning 7 to 8 to 10 in maybe a normal year. And then in down years, it's less, and in up years, it's more. But you hope after the end of 10 years, not only have you maintained the corpus, but maybe you've earned a little bit. Those earnings are not taxable. And that means that as the corpus grows, maybe without further contributions, because of investment earnings, the donor doesn't have to pay taxes on those earnings because it's community foundation ownership now. And that $4,000 becomes $4,500, becomes $5,000. And it's wonderful for us to see that at the community foundation as those funds grow. Okay, so we'll move along. Community Foundation Impact Fund. And I really want to emphasize this fund is a wonderful opportunity for people who love Long Beach. Maybe they don't live here anymore, maybe they grew up here, but this is a very special fund because it's totally flexible to what the exact needs of the community are today. And our board of directors, who are made up of professionals in the industry like you all are, and also members of boards like Tony, that know and understand this community, they're the ones that decide and pick the charities. We have a $3 million endowment, so you can see the amount gifted there. Great opportunity for legacy gifts. If maybe your client doesn't, or you don't know exactly the charities, but you care about Long Beach, and you know that in the future, there's going to be some really significant issues. You can see some of the issues that we've supported here over the last 25, 26 years. And we didn't know that, we'd have the homeless problem that we did, back in the late 90s. Nobody could have foreseen that. But this fund has supported youth on the brink of homelessness, families, really trying to make a little bit of a dent to help those charities that are on the front lines to helping folks with homelessness. We've added a lot of education now, considering the past couple of years. So please contact us about this fund, because it's the only fund that exists that can really support what exactly the needs are of today. Everything else is solidified, but this one is constantly evolving and changing. And so it's a great for a client who lives here or used to live here that really wants to support Long Beach. All right, the famous donor advised fund. And we make sure you cannot send an RMD to a donor advised fund. We will reject it. But you can. There are some clients, and Tony's got an illustration here, that say, I want to put it in my donor advised fund, and I don't care. I will go ahead and pay some taxes on that because I like the idea of picking and choosing when I want to be able to give it out. This is closest thing to it is a charitable checking account. It's great for individuals that maybe are giving to charity here and there. Maybe they give as they're asked and they'll go long periods of time without giving. They really want that flexibility, and they want to be able to go into their account on our website, and maybe as they see something come up or as a charity friend asks, go in and direct some money. There's no limitations on there in terms of dollar amount, time of year, and all of that. The tax deduction is taken at the time of contribution for us in that particular year. And then after that, income is earned and distributions go out according to the client. And they know who they want to support. So this is really right for the person who has that mindset of, I want to choose when I want to. And I don't want it to be by the community foundation. I'm knowledgeable. I'm very involved, and I know where I want my distributions to go. And so, Tony, here's the tax effect of that, just for folks so you can see, you do have some tax savings there.
Yes, you do. So in column 1, you'll notice that is the usage of the qualified charitable distribution option. For the QCD, that's if you were to have your RMD sent directly to a designated fund or one of the field of interest funds as previously discussed, and also the community impact fund and the scholarship fund. So if in this instance, your income, your ordinary income was 100,000 and your RMD based on your age was 63,000, you would effectively exclude that amount from your adjusted gross income. You would still have your standard deduction if you were not doing itemized deductions, and your income tax would be approximately $14,500. If you wanted to still be in control of or somewhat have influence over the funds once given, and you wanted it in a donor advised fund, you would have to recognize that income in the tax year of the gift. So your income would be 100,000 plus the 63,000, and then you would just get a charitable contribution deduction of the 63. Now, the difference in this example is that the tax savings is on the fact that because the amount was excluded, Mr. Beach still gets to take the standard deduction. So he's in effect getting the tax savings on that standard deduction. Whereas if you do an RMD and you have to do itemized deductions, you don't get that additional tax savings on the quote unquote free standard deduction. So there's a slight tax savings amount there, but in any case, you would be reducing your income no matter what you do if you were to give to a QCD or directly to or to a donor advised fund.
Great, thanks for going over that. We do get a lot of questions about that. It's so nice to have a CPA in the room to kind of walk us through that. And it's a personal decision, as these all are, right?
One other point, Marcelle, is that the qualified charitable distribution is not an all or nothing thing. So if your RMD is 63,000 and you wanted, let's say you had usage for the funds elsewhere, you can decide to only put 23,000 into a qualified charitable distribution. So I don't want anyone to walk away thinking that the complete RMD needs to go into a qualified charitable distribution. You have the option to split it between the QCD and a normal RMD, or even QCD, donor advised fund, and a normal RMD. None of the options are all or nothing.
Right, right. And that's that flexibility that I was referring to later. So the best thing to do is just to contact the community foundation to really find out what the needs are specifically of you or your client, and we'll design something that works for them, because there's no cookie cutter way about it. Here's another poll. I believe it's our last one. And Tony, do you want to introduce it?
Sure. Okay, so Marcelle went through a few of the funds here, and the question is, what type of charitable funds can RMDs go directly into? And it's a multiple choice answer.
Let's give folks a minute.
Okay. And so RMDs can be sent. The question is, which funds can RMDs be sent directly to from the IRA custodian?
Oh, I think people are changing their answers. We see a little.
I'll give a hint. One of them is not applicable.
Yeah, yeah. So choose all that apply.
All except for one.
Okay.
All right.
That's
I think
it.
we're almost there. Yep. Okay, so the answer is that all of the funds except for the donor advised fund can directly receive RMDs.
Right. So you have to direct your IRA provider to send it to a 501c3. But once it hits like a community foundation, that we'll direct it from there, but we can't put it into a donor advised fund from there. So you could not say to your IRA provider, send it to the Jones Family Foundation Fund at the Long Beach Community Foundation, which is a donor advised fund. We would turn that around. So that would be like a direct payment from your required minimum distribution into your donor advised fund. It'd have to come into income first for you. And that was the example that we gave earlier. But it could come to a 501c3 like the community foundation, and then go to a designated fund, a scholarship fund, field of interest, or the impact fund that we talked about earlier. Okay, tricky questions, right? So this last portion we're going to talk about, we've got about 5-6 minutes left, is the portion that once your client, are getting ready for that conversation of what do you put in your trust, and looking at your bank accounts and looking at your IRA accounts and naming that beneficiary. So one great way to continue on maybe something that you've established that we talked about earlier, or something totally new, is to leave the Long Beach Community Foundation in your trust, because we are the 501c3. So you see the information there, and then maintain a document with us called a Memorandum of Philanthropic Intent, or MOPI, as we call it here at the foundation. It's a 1-sheet paper, and I know that's small print. Anybody who would like this document, it's on our website, or we'll email it to you. And you can see a checkbox there, and if you can see it's this designated fund or field of interest, you've got different endowment options. And it's just an agreement between the client or the donor and the community foundation. And really, it doesn't activate until we've received notice that your trust has been activated by the trustee. And it defines exactly what the client wants to pursue. So you could leave a number of instructions there, and a week later or a year later or 5 years later, you say, you know what, I want to do something different. You could go back to that same document, change it, send it to us. It lives outside the trust. So you name one charity in your trust, and that's the Long Beach Community Foundation. You never have to go back and change it, because you can change it with that MOPI form at the community foundation. You can name charities, you can name causes. And the nice thing is the client can change their mind as many times as they want. There's no fee for that. We just initiate what the latest document is on file. And if you're working with a financial advisor, the financial advisor can continue to manage the asset, and even get the family involved, maybe the children or other dependents, and get them involved. So we do see a lot of that, and the community foundation will initiate whatever the instructions are on file. If you're a professional advisor, you might say, well, how do I get that conversation started? Contact us. We've got some great resource documents that we can look at. Tony, you've got some really great content on your website, and following you on LinkedIn is a great option too. Do you want to speak to this briefly?
Yeah. Our website has plenty of articles and background on not only the qualified charitable distribution, but any other thoughts that you may have with respect to retirement account planning. We also have several videos on YouTube, and you can follow me on LinkedIn and the firm on LinkedIn for regular distribution of information and resources.
Wonderful. And if you were to visit our website, we have a whole dedicated portion to professional advisors. You might be able to see the drop-down menu there specifically for the 3 disciplines of financial advisors, estate planners, and tax planners. And then each page has, tons of resources for you. We recently added this most requested documents and information. So if you don't, have time to be poking around and looking at stuff and learning and investigating, you go right there, drop-down menu, and you can get what you need easily. If you visit our website and you have some recommendations for that, kind of that quick information that you don't want to have to search for, please tell us, because we want to make it easier for you when you've got a client coming and want to speak to them about a particular issue. If you go to where that arrow is, the Give Later button, you'll see a lot of online tools and things there to help you come to some decisions. We have reached almost the end of the hour and the Q&A time. And I don't see any Q&As in the Q&A feature. So jump in now if you have something. In the meantime, I will say one of the questions that we get a lot at the foundation, well, what is your fee? And since we are a charity ourselves and we are in business to provide a supportive services, they are quite low. They are just to provide the minimum amount to cover our costs. Typically for a fund under $1 million, and we have a lot of those, and we also have ones that far exceed that. So want you to feel like if you're not $1 million or $3 or $4 million individual, that maybe, the community foundation isn't right for you. That's totally false. We have funds under $1 million. And the fee for that is around 1%. And then as you go up higher, the fee comes down dramatically. And we do have a special rate for financial advisors who want to retain that investment management, because we want to make sure that it's cost effective for your clients. So we do drop our fees as much as we can for that. But that's kind of a general kind of you go to answer for that. Tony, do you, with the minute we have left, We want to get you that 60 minutes and get your credits. Is there anything you would like to add to that?
No, I just want to thank everyone for taking the time to join us today. And I hope the information was helpful and useful. And if you have any questions, please feel free to reach out to Marcelle or myself, and we'll be happy to help.
Absolutely. And you will get an email with the presentation recorded, and you will get a PDF document. And please click on the link, answer our 3 or 4 questions quickly, just to give us some feedback on what you thought about today's webinar. We've been doing these for a few years, and each time we try to improve them and make them even better than the last. So thank you, Tony, so much for taking your busy time, especially before the 30th. All CPAs are very busy around this time, and sharing your knowledge. It's just been incredible to hear what you've had to share with us today. And with that, we'll bid you a great afternoon, and contact us if you have any questions, and have a great day.